Let's see here. Let's start this off by answering a few questions I got beforehand, and then from there we'll just take any questions that you guys may have. Hopefully, as we keep this going on a weekly basis, that we get more attendance and just more people that are interested in finding commercial loans or loans for real estate investors. Let me just start off with the first question. It's, I think this is from Rupert. It said, fund to reinstate a mortgage so I can buy the property. Okay, so basically it's either distressed or in foreclosure. Reinstating a mortgage, if you're buying a property, you would have to contact the lender or the court that has a foreclosure in. Could be the bank also. And then you could find out what the terms might be for that. As a lender ourselves, we can fund a purchase of any property that's in foreclosure or that's in distressed. We just need to find out what that purchase amount is. So I guess in short, the answer is yes. We can lend on a purchase of a property. But to find out terms, you would have to contact the lender or the courts regarding that foreclosure. The second question I have is, I have a home that I inherited that needs some repairs. How do I get funds to repair it? Okay. If it's remember, we only do non-occupied investment properties. So that's first case. Just make sure it's that you don't live there or you have family that live there. It has to be investment property. To get funds to repair it, you would have to refinance it with a construction loan to do some kind of renovation repair. So you would have to have the loan to cover the value of the house and then the cost of the repairs. So you can't just get a HELOC or line of credit or something like that. It would have to be that whatever debt is on there, we'd have to refinance that debt and then put the repair budget on there also. So that would just be, basically let's get the numbers and see how that would fit, as long as it's an investment property. Third question. I'm needing to know what a DSRS. Okay, so a debt service coverage ratio is DSRS. I'm guessing that's what they mean by that. And it says, do we lend in states Arizona, Alabama, South Carolina, North Carolina? Yes, all those states, DSCR loans are available. And DSCR loans in general is basically, it's a debt service coverage ratio. So basically it's a loan that's based upon the NOI divided by the debt service. So that's the typical formula. So you get your net operating income. So you got to take out, it's an NOI is typically, it's like you take your rent minus your taxes, insurance, HOA, property management, any kind of maintenance. And then so you get your net operating income for the year. And you divide that by the debt service. And the debt service would be whatever the interest only payment is going to be. Or in this case, it might be principal plus the interest. So we like to have that number to be about 1.15 as a lender. I mean, right now we know that it could be, because the rates are kind of high, it might be under 1, and at times we'll allow that. It just depends on how high the FICO or credit of the borrower, and take a look at the property and the market, et cetera. So there's a few factors into what that number should be, but I would basically tell everyone that's buying a property or looking at putting a DSCR loan on a property to be definitely higher than 1, closer to 1.15. So basically, simplify is like this. Okay, if you're paying $1,000 a month for that debt service, means the principal and interest, then your operating income needs to be over that 1,000. So if it's 1,000 to 1,000, there's a 1.0 ratio. And we want that to be like a 1.15, that your income is higher than debt service. Hopefully that answers that question. And I guess feel free during the week to put these questions in there, because it gives me time to look at the questions beforehand, then answer and go over these questions right away before we start with anyone's questions, new questions. So without further ado, let's just start with any questions, and let me know if you guys have anything. If not, I'll start with just some random thoughts during the week. And then I'd like to get some insight on what you guys think, what you would like to know as we go through this training. Sometimes when I work with my originators or work with brokers, is I'll give them some of the loans that or requests that we got during the week. That's kind of interesting, or kind of what you might be going after out in the market. Right now, there's a lot of I think there's going to be a lot more interest in finding properties, especially if it's going to be a value add, and you're going to hold it for like a long term, or like you're just holding it as a rental property. And so there's a lot of interest in that buying, fixing, and then holding rather than flipping. I think that's going to be basically your number one target for about the next, I would say, until the first of the year. Hopefully the Feds don't raise in September, and they're contemplating November. If it doesn't happen, then I think we look really good on rates not going up for the foreseeable future, and hopefully next year they start actually lowering. So next year can be very good, as long as nothing in the economy catastrophic happens, and some of these banks will get in a better position. So you'll see rates, I think, next year start to come down a little bit.
So Jason, are you saying that the rates going up will better position us for getting?
This is the way I look at it. As the rates go up, every situation has like positives and negatives. As rates go up, for a investor, you get more opportunity. If you're in cash position, you get great deals right now. So you want to look for people that are looking at opportunities and can, I know it's not your role to work with the seller, but sometimes it fits where you can say, hey, will the seller finance any of this? And do seller finance, because as a lender like us, we'll take a second position. So if someone wants to seller finance and get the loan, that works too. It's kind of like a hybrid mesh. Let's say you're paying 10 or 11% for the loan, but you're getting the seller carry to 5 or 8%. So between the two, you're at somewhere around 9s. That's what a buyer should be looking for. Buying with cash and getting a good cap rate means that you're getting a nice healthy return on your investment. That's available right now. Because of the rates being a little high, you just have to look for different types of opportunities. Now for us, as a lender or as a broker or as an originator, is our advantage right now is you're not really going to find too many people that are going to haggle you over rates. They're just basically saying, can you guys fund this? So, which is nice. Sometimes you ask yourself, hey, would I want a good market where the rates are low, but then everything is about rates and about points? That gets to be a little annoying that they're using you as leverage to go into another funder, another lender. Right now it's basically, first question is, are you guys funding? And so, the answer to yours is yes, we are. It is a little bit tougher than usual, but we are, and that's the number one thing right now.
So
So
you
I
said number
don't
one
think you're
question
gonna
they
fund.
asked, are you funded?
Are we funding? Yeah, so
Okay.
there's two different types of funding right now. Most lenders, and this is just throughout the private lending area, is they're going to secondary markets. So secondary market first. So basically saying, hey, we de-risk our portfolio by finding a secondary market. So basically banks, insurance, family offices, et cetera. Sometimes companies like Goldman or BlackRock or something like that are buying notes. And so you have capital partners, and secondary market is a little bit tight. So they're going to have be a little bit more strict on the underwriting. But that's first. Now, the second thing is where you would have your own fund. And so we have our own fund, but that's our secondary. The fund, it's not as profitable for us to write loans and hold them compared to just writing them and then selling them off to the secondary market. So, but that's strategy what you find on lender. But the short answer to your question is yes. And there's two ways to fund it. One is the secondary market, and the second way is our own balance sheet. And our own balance sheet will take on maybe some things that not fit in the box. For example, I'll give you one that we did this week. There's a guy that had a 650 FICO, and they need a 680 FICO to get this done. But as we know, the economy has been very difficult for last year. So he's had to put a lot onto his credit cards and et cetera. So I had held high balances. There's just no way that we were going to get his FICO to 680 by the time he needs to close on the property. The guy has very good experience, property's in a very good location, and the value of the property was very good. So we wrote it on our own paper, and he had a solid exit. So as we look at it, it is a case by case. So we say, many times we'll say, hey, he needs a 680 FICO or a 660 FICO but remember, when times are good, we're taking things at 620 FICO. So it just kind of goes hand in hand. We just, for the most part, credit means a lot right now, because credit, you're de-risking your portfolio because you're saying this person has a history of paying their debt. And so you use that as a big factor right now as we look at distressed properties across the whole lending sphere that's out there. And so FICO means a lot now. It didn't mean as much last year. It was more of the property and liquidity and experience. But right now it is FICO, unfortunately.
So what if his FICO was a 650, and he had a 30-day late on a credit card? Could you still fund him?
Yeah, as long as it's not a real estate. The biggest thing is we don't want him to be late on any kind of mortgage payments or any kind of real estate related payments.
Okay.
So that's our biggest thing. When we look over a credit report, I mean, we understand that you're going to have a late payment on school, or we're going to have a late payment on credit cards, or even your auto payment, things like that. But if it's on real estate, then it's tough, because if it's on your mortgage, that's a red flag for us. So is there any other questions? I want to take questions before I go into some of my thoughts for the week. And I preface that by saying these are my thoughts. So this is what I am going through on a weekly basis. So next week might change, especially some of the loans that we are processing and loans that we are underwriting right now, or maybe loans that have closed. So kind of give you an idea. A typical loan here, and as I see, there's no questions right now. Let me see, is there anything that come up? Hi, good morning. Okay, so there's a question regarding the business. Okay, so Alan will take care of any of the business questions. I see the one that we have a message about business plan templates, etc. But there's a lot of good ones online. If you, yeah, I mean, Alan, I'm sure would have this specific, but if you just go on to SBA, they'll give you a lot of ideas of how to put together a business plan, especially to get through the SBA. So those are good templates to find online. Okay, so let's go through some of these properties that you get an idea. So person just bought a house and they bought it from a distressed scenario. They just purchased it and they won it on a auction, I believe. So they bid for it and they won it. So let's say you have a customer that bids on a property and they're wondering, well, how do I get this funded? Because I only have 3 weeks. I've been rewarded this and I only have 3 weeks to close on it. So what we normally need in, I would say right now we definitely need is an appraisal. Okay, so let's say the person won this house. We have a problem with the appraisal because they want it on a bid and they can't actually go in there. So they can't go into the property until they actually acquire it. So it's kind of
a fix and flip.
That's it's just an acquisition. So because you don't know what you're fixing yet because they haven't been able to go in the property. They just know that they're getting a good value based upon the value of properties in that area, and they don't know exactly what the budget is. So let me go through two scenarios. One is someone new and someone that's experienced. Someone new, so they want to buy this property. We're basically just going to go by that property value, that their purchase price. We are not going to go by the appraised value. We would still need the appraisal, but we could do kind of an exterior drive-by type of appraisal. So basically, they can just we can have the appraiser go by there and just kind of give their opinion and give us the comps in that area. So let's just say that the house, they're getting it for 200,000. So we would go up to 80% of that purchase price, most likely 75, but let's just use 80 if their FICO is really good. 80% of the purchase price, so it's going to be like 160. They're going to have to bring about 40,000 plus closing costs to the close. That's your typical auction. So if anyone ever asks you, hey, what will you lend on that kind of scenario? Now, let's say that you have an experienced person and they said, okay, I can buy it for 200. There's about 40,000 I need to put in there. I'm approximating 240 because the value of that house in that area is about 400. So there's a lot of good upside on that. Now, for someone like that, we will put what we would call we would put in there a $40,000 budget, and then we would price it out where they would purchase it, then refinance it out with the renovation afterward. So we could do a loan after you purchase it. So we could readjust it with actual renovation costs. But let's just say that 40,000 was accurate, and they could just go in there and do that. Now remember, on a fix and flip, when you buy for 200 and you have 40,000 in renovation costs, the 40,000 is your kind of like, your budget. It's you don't have to, it's a draw account. So if you don't use as much 40,000, then you don't. If you go over, you have to spend the money. That's why you go over it. But if you have to readjust the budget, then you just, what we would do is maybe have the appraiser go up there and give an updated appraisal to make sure you get the higher value. The monies you're spending for the renovation makes sense with the value of the house, etc. So in short, there is ways to work with individuals that win auction or distressed properties right now, and you're going to find a lot of that right now. People are looking for those type of properties. There's some banks that have 40%, even higher. Some lenders, 40% of their loans right now are distressed. Means that they're either late payment or they're going into foreclosure. So you might wonder how foreclosure works. And foreclosures, as a lender, we give it to an auction or bidding when it goes into foreclosure. And then and every state's a little bit different. So let's just go primarily, most states, that if we don't get the amount that's owed to us, which is the outstanding balance, then we take it into our REO, and then it goes into kind of our assets of real estate that we own, and then we need to sell it ourselves. But if it goes over it, then it pays off our loan, and the auction winner gets it. And typically in most states, the amount that goes over what's owed goes back to the actual owner, original owner. So it's not a bad deal in that regard for them, but they're going to have foreclosure on the record. So it makes it very difficult for them to get investment properties in the future. So that's one. Any other questions while I'm going through? Don't see any. And you guys can ask me anything about lending. You guys can ask me anything from what are good ways of marketing. You can ask me what are good ways of loan originating, like just getting people to who you should contact. We can go into origination, like what are the main questions we want to find out. We can get into underwriting, underwriting practices, where I might see out, forecasts. Let me go through another one. Okay, so this is typical right now. Let me get to this question. Do you work with personal home refinance? No, it has to be non-owner occupied. So yeah, if you're going to go for that, for any kind of home refinance, you would have to go to a traditional mortgage or to your bank. It's kind of tough to do. But with us, we only work with investment properties, non-owner occupied. So here's another one that we closed this week was, and this is typical. This is typical, like probably the most typical right now, is refinance of a finished renovated property or built property. So you're a builder, you built the property, you're having a tough time selling it. You're a fix and flipper, you fix the property, but you're having a tough time selling it. So we'll put it into a bridge loan. And there's two different ones. We could go into a DSRS 30-year loan, or we can go into a bridge loan. Now, I'll tell you the difference between the two. And so these are the options for your clients. So they have a property and they just finished the renovation, or they have a property, investment property, and there's two ways to look at it. One is a bridge, means I have it on the market. I'm going to put it on the market. I need, kind of like a gap funding in a way, but you need another 12 months because it's, you give it time to sell. And if it doesn't happen in 12 months, maybe you put into a long-term and keep it. So bridge loan is going to be on the average about 10 to 11% right now. 2 to 3 points, just depends on their FICO and their experience in the property itself. So we'll take a property like this one we did. It's in North Carolina, and the person did not qualify for a 30-year. And remember, the 30-year is kind of tougher. You have to have a 680 FICO. There's a lot more scrutiny into your just everything. It's not, you don't have to worry about the income, but you do have to, we do have to take a look at your previous credit history, or basically if you have any liens, or if you had any type of defaults anywhere, et cetera. So it's a little bit tougher, but for the most part, 680 FICO and the property where it sits, and you're going to get the rates right around 8 right now for a 30-year. And you get it for different types of prepayment penalties. Most typical one is a 5-4-3-2-1. So those are the two options that a person has once they're finished. So they could either put into a bridge loan, give it 12 to 24 months of time, and it's a little bit easier in qualifying. And then there's the ones that are going to be looking for a long-term 30-year rate, and that would be a little bit tougher to get. And but there's usually an answer for either one. Okay, so if someone doesn't qualify for the 30-year, we could look at a bridge scenario. Do you work with, okay, hi, is there a way to get a list of foreclosure from you or Sequoia in the area? Thanks for what you're doing. You know what? I think we as a whole do not list ours because we don't sell them. We have buyers for ours if we need to sell. For the most part, we don't have a high default rate. We're at about 5, so ours is a little bit different because we try to work with each one of our customers and our borrowers, because we know our borrowers are going to, anytime you get a customer, think about this. That customer is worth a lot to you because most time as an investor or as a builder or in the real estate market, you can do, in a given good market, you can do more than one project a year. So same thing with us as a lender, is we're going to probably write 2 or 3 different loans for them in the next couple of years. So we like to do everything we can with our borrowers, especially if we're sitting in a good asset spot, which means, let's say that they owe us 60% of the asset value. We don't really want to lose that customer, but at the same time, we have a good asset as kind of our de-risking, our helping that individual. But we will put them into, we'll give extensions. So for example, we'll do a 1 point, extension, so they can extend it for another 6 months, or we do usually 1 point for 90 days, but if, I can work with them and give them for 6 months, etc. So a lot of lenders will do that to try to keep theirs. We don't buy notes ourselves, so I don't go after those type of lists, but they're available. So you can go to banks, you can go to just different, there's different lenders. If you call them up and you can ask them if they have a list, but they're not just going to give it to you as a broker. What you're going to have to show is that you can purchase a whole book of business from them. So if I get my hands on it, maybe I'll talk to Alan about listing how we can do this, but they really don't want us to individually sell notes. It's going to be a book of notes that you're going to purchase. So if there's if someone has 43 foreclosures or in distressed properties, that they would want someone to buy all 43, not just to buy 1 or 2. So it's one of those, if you get your hands on it, it's great, but I don't know if anyone's going to just let you individually go after each one. So a buying group might buy 10 to 12. But if you can get to the owner before foreclosure, that's your best bet. And sometimes the city has that, especially with banks. Sometimes that's public record. So I think in your area, you'd have to see if homes are getting close to foreclosure, and then you can work it out with buying it from them or working out some kind of seller finance, or get them out of their hole, see what their debt is on their actual property. So if we find anything that will help you guys, and we think we could do it on an individual basis or as a region, we'll look into that and see if what we can do and what we're allowed to do. Next question says, would you finance new homes, single family or duplex or rental income? Yeah, would you finance new homes? If this means construction, yes. This means purchase, yes. So as long as it's an investment property, yes. Single family or duplex for rental income, absolutely. That's probably the strongest type of note we want to do, is because it's producing rental income. if it's cash flowing, there's just absolutely no reason why any lender right now wouldn't go after those. So yeah, so the question would be yes. Now, what we won't do is do spec houses. So if you're doing like multiple, like 10 to 15 spec houses right now, and even though you're saying you're going to keep them for rental income, that's going to be a little bit difficult. We might ask you to do like 2, 3 single family, and then get them stabilized, and then we'll go to the next 2 or 3, just to be safe, both sides, just so you can build them and not get them stabilized before you go to the next ones, etc. There's ways to work around it if you're experienced. So, but the short answer to that, yes, we would finance new homes for rental purposes to hold them. Next question says, I have a deal transaction from a referral that is valued around 250 million for a 1.8 million square foot commercial warehouse in Los Angeles. Okay, so unfortunately, 2 things there is I don't do specifically commercial buildings. Now we will do a mixed where it has at least 51% residential component to it and 49% commercial. So for example, you have those buildings, which is 3 floors, 2 floors above is residential, and the 1 floor below is some kind of commercial space that we can do. But on a commercial warehouse, that would be different. So the answer to that is unfortunately, we do not. Now, you may present that to Alan, and for commercial lending, he might have someone there in Los Angeles for that. Commercial warehousing is tough right now, okay, just in general. The economy is not the greatest for that, so the warehouse would have to be specific for to a specific need or client. But I think if you ask it around enough, you should find someone that might have an interest in that, especially in Los Angeles. So that's just something that you would have to work with Alan team and see if they have something for big commercial buildings like that. To start the construction. Okay, so it's a brand new construction. Okay, so yeah, it's the same though. You'd have to go through a construction. I mean, usually banks are the ones that fund those type of those kind of warehouses and etc. Okay, next one is inherited house that needs repairs that can apply. Inherited house that needs repairs. Can they apply that for a loan home equity of home? Okay. Inherited house that needs repairs. Okay, so this is a new property. It should be a rental property that you're not going to live in, and you're going to rent it out. Can they apply for a loan off the equity of home? No, we would have to refinance the whole thing. So you'd have equity in the home, but we would have to be the first lien lender. So it means we would have to take out the lender that's on there right now and then give you a construction budget for the renovation. So give you an example, you inherit a house, it's 200,000. The note on the house is, let's just say 100,000, 50%. And you need to do about 10% or $20,000 worth of repairs. So they would need to refinance 100,000 and add on there the 20,000 of needed for the repairs. So we would have to be the first lien lender of the total of the 120,000, and you should have enough equity there to not have to bring any money in. In fact, if there's enough, if the home is paid off, then what you would get is for example, for us, a minimum loan amount is going to be 150,000. So it just depends on what the loan is for. If you would get a cash out on something like that, if you inherit a house, you would get a cash out, and then you can either do your own repairs or you can take a renovation. But we would still have to be first lien lender with a minimum of 150,000 note. That's our minimum amount that we'll write a note. And so it could be a bridge, or we could put that into a 30-year. But we won't do a line of credit. So they would have to go to a bank and see if they can get a line of credit. Some banks will do it right now, and that's their best option. Or some kind of hard money lender might do that same thing, where they say, okay, we'll give you, $40,000. Your house is paid off. 40,000 for a line of credit, but we're going to put a first lien on it. So it's basically the same thing, from a hard money lender, just like us. We'd have to put a first lien. The only difference is ours minimum is 150,000. For a hard money lender, they might give you 30 or 40,000. To get a line of credit, though, you would have to get that from a bank. Okay, so I think we took care of all those questions. Let me just go through. I'm just going through some of my emails that'll give me a better idea of. All right, so here's another one that we did a cash out, and this is a person that owns apartment buildings. So we will do multifamily and apartment buildings by case basis. We like to say that 1 to 4 and up to 10 units, but at times we'll look at properties, like I said, strong borrower area, we'll look at opportunities. So in this case, he has 95 units in Texas, and the 95 units are, he's owned them for a while. And what he wants to do is pay off, well, he wants to take a cash out because he was looking at buying 2 more investment properties. And so typically our cash out max is 650,000, but we're giving this guy close to 2 million. Because a couple of things I look into it. One is he's strong credit, strong history. He's owned it for 6 years. So he's not it's not leaving anywhere. He has enough equity into it. We did the appraisal. Appraisal came spot on what he was anticipating. He has a property management on site. It's run well. So there's a lot of things, and that one there is we got our secondary market, basically our capital partner on that one, to sign off on it. And so on a case by case, we'll see what between our underwriting and our capital partner, if they will take on that property. So we will look at things that are kind of outside the norm. And this one took about 45 days to from start to finish. From the time he gave us, it took about 2 weeks to get the appraisal completed. During that time, we had to get all the leases, just look at all the paperwork. So it took a little bit of time, but for a $6 million property, that's not bad, that amount of time. So that should be about the longest any loan should take to close, is 45 days. Typically, I like to tell people within a week after we get the appraisal back, we should be able to close. Because appraisal might take a week or 2 weeks, and then a week after that just gives us all the appraisal does is basically it just tells us the assumptions going into given that loan proposal was correct. If it comes on lower, the appraisal is lower than what we expected, then it's going to change the loan size. If it comes back higher, then it's not really going to affect anything. In fact, the borrower can ask for more money or more money on the loan, et cetera, if it comes back higher than what they anticipated. Okay, so let's see here. I have another question. There are new developments of a neighborhood selling condos. Would you finance this for rentable income? Yes. As long as, like I said, as long as you don't put yourself or your family members into it, and just make sure that you're arm's length away from the person that's renting it. Yes, we will. The condos right now, in fact, negotiate with them and try to get as low as possible. And but that's a typical thing right now is buying new properties, because there's too much inventory in many cities. And so you can work with the builders and to the developers to get a lower price than they maybe they're even asking. So in some of the ones that the builders, if it's a builder, they might even give you some owner finance. So what you could do with let's say you have a builder that's building like 4 units or 5 units, like these condos, instead of someone that's like a big time, like big time builder, like Toll Brothers or something like that. They would have their own in-house kind of like perks that they would give you to buy from them, and they would have their own financing setup. But some of these smaller builders and developers, you can actually go in there and say, okay, so let's say a typical builder that gets a construction loan from me, they build a house for 200,000, but they're going to resell it for 400. So building for 200 is resell it for 400. They're done building it. Remember, it cost them 200. 10% carry maybe cost them 220 overall to build that house. And now they're not getting close to 400. And they're saying, oh, maybe I could sell it. They're all the way back down to 300 now, let's just say. So they're still making about $80,000 profit. Now, you're getting a good deal because you find out that, new homes or new condos or new are valued at 400,000. You can get it for 300. You can actually go in there and say, okay, I'll give you 250,000. And then if you can sell or carry 50,000 and for 12 months, something like that. So you can actually get some decent deals from smaller builders that might do, because all they're caring about is paying off their construction loan. So in my case, they'll pay off the 220, pocket 30,000 and have 50,000 that come in to them in payments for the next year. And they would be sitting in second lien position. So those are ways that you can negotiate as an investor or as a buyer. Yeah, and if you have follow-up questions to some of my answers or need better explanation, let me know. Sometimes, everyone uses acronyms, or just we assume that someone knows exactly what we're talking about. There's no such thing as, like dumb questions, or just like questions that you don't ask me for clarification, because this is how you learn. Because remember, what you say to your clients or to people out there, you need to know what you're saying. So if you're just repeating what someone else told you, you don't exactly know what that means, then it's going to come across unprofessional, or maybe just like unknowledgeable. So you want to know exactly what that means in your own interpretation. So let's go through another one. I'm just going through. Okay, so I was at the Florida Association of Mortgage Professionals, the FAMP, last week in Orlando. And that's the biggest show that we go that's not national. It's Florida, because most of our loans, we started in Florida when we started in 2013, and Florida is still our biggest market. And so we annually attend that meeting and have a booth there. And I was attending the booth. And what I saw there was it wasn't as busy as most years there. We had a bigger space. So it tells me that they didn't have usually we have a tiny space. They like cram us in there. But we had a bigger space, so it tells me that there's a lot of lenders that kind of either fallen off or maybe didn't put that into their budget to attend. So, or some services, as lending goes, so does like all your service companies, your appraisal companies, your title companies, your software companies, etc. It kind of goes hand in hand. So what I did find out there, though, is the brokers there that are licensed in Florida were telling me that the biggest thing that they're seeing is that there's a slowdown of construction, but there's a lot of properties that are for sale or are for fix and flip opportunities. And so there's a lot right now that you can, especially in certain markets, that you can actually look for smaller properties and fix them up and then hold them, because the rents in Florida still have not come down. So it actually is very lucrative in a way to purchase some of these on where the sellers have to sell or they want to sell, and maybe their carry cost is too high for them, and so they want to sell. So you could go in there, fix it up, and put into a 30-year down the road, like bridge loans to purchase and renovate. That would be my strategy right now. If I'm investing, I would look for fix and flips, fix them up, take a bridge loan, and hopefully the rates go down so you can refinance it to a long-term, let's say a year from now. Don't expect to sell it on the market. I would say it's mostly to hold. Next question we have, are we able to use these fundings in the U.S. Virgin Islands? No, unfortunately not. Even though that's a territory that, you know, it's like Puerto Rico, U.S. Virgin Islands, et cetera, that they just, it's a special type of license that you need to lend in those areas. So it's not the same as the U.S. states. Okay, let's see here. So that was that. And we do have another conference that's coming up here in Vegas in September that'll kind of give us a better idea on a national scope. I think NAMBI or something is coming up. I know that I have to attend a trade show in early September here in Vegas. Okay, so here's one that here's a project from Canadian. Okay, so this is kind of unique. So this is a Canadian sponsor. So we do lend to foreign nationals. They just have to have a U.S. bank account with an entity. So all of our loans is given to an entity. You can't, it's not under someone's personal name. So they would have to set up an LLC. So whatever property you purchase as a borrower, you just put it into an LLC. So many times you'll see 123 Main Street LLC type. That's a typical, type of LLC. It's just the address of the property in the LLC. So this person here, so they have a U.S. bank account. They have a corporation. They're incorporated here, and so this is what they're doing. And I'll show you the difficulties and the ease of doing this property. So we can look at both sides. So as I look at it, okay, so they have a 187,000 acquisition costs and 166,000 rehab costs, and the resale value is going to be 450. And I'm just throwing out these numbers just so you guys get an idea of how I originate and underwrite, pre-underwrite, and before I send out loan proposals. So about 340, and they're going to resell for 450. And I looked at it as saying, okay, at the end of this project, if he sells it, he's going to be making about 50 to 60,000 on it. So about 15 to 20% on an annualized basis. But if he sells it before, he can make about 40 to 50% on an annualized basis. It's not bad. It's not great. I would definitely say, with the carry cost as high as it is, I would ask them, 450 is that on the high end or on the low end, because that's going to present maybe a problem, because the 450,000 and you're putting in 350 into the cost. That means if the appraisal comes back and says it's only worth 420, we're probably not going to write the loan. So I would have to know exactly what the comps are in that area before I would feel comfortable of giving this loan. Now, with his experience in Canada, he has done quite a few fix and flips up there. He's migrating toward the U.S. and So he has a cost in rehab, and I'm confident that he knows his construction costs and what he needs to get done. But just not confident if he knows the actual resale value. So that's going to be dependent. That one there, because the margins are kind of tight, is too dependent on the appraisal, which I don't like, unless he's valuing on the smaller end. If he's valuing on the smaller end, and how I look at that is saying, okay, what's your cost per square foot? And then I look at it as comps in the area and see what their cost per square foot or value per square foot, and see if that lines up. So if his value per square foot is lower than the others are in line, then I feel comfortable with the 450. But if his value per square foot is higher, then we might have an issue there. So in that regard, let's just say that we went through it and we gave him a loan proposal and he accepts it. And I gave him a loan proposal, and to give you an idea, so the loan amount is, and I'll just go through what his loan proposal is. So you saw it was about 350 in costs. So his loan is going to be about 260,000. He would have to bring in, let's say at closing, he would have to bring in 105,000, and he would have to have about 20% of his construction reserve in liquidity. So about 30,000 approximately in his bank account beyond the closing. So about 130 to 140,000 he needs total. And the numbers are okay right now. They fit within that. He's going to have to pay 11% because he's a foreign national. If he's here in the US, you probably get down to about 10.5. And his origination is going to be 2.6 points. Okay, so on something like that, we can get lower if they're in the US. It's just cost of money. It's a little bit higher these days. So you're not really going to get lower than, let's say, 2 at this moment. Maybe in a few months might get lower just a bit. So I talked to him on the phone, and he's probably going to go through with it because he thinks that he has a buyer and he can get this thing done in 2 to 3 months, which is fine. But I would have to be convinced that he can get it done in 2 to 3 months. I just wanted, once I send out a loan proposal, I'm going to take a look at his actual renovation work and scope, and then use my knowledge and ask a couple others that are in construction department just to make sure that that's feasible in that area. So every area is a little bit different. Make sure there's no additional square footage he's putting on, because that means a permit has to be involved, and depends on the city. You know, we don't know how long that permit can take. So there's a lot of things that go into behind the scenes, but we make the decision in less than a week. So it sounds like there's a lot of things that we need to look into, but every loan, we can make a decision within a week if we're going to be able to extend a loan proposal. Once we extend a loan proposal, in a given good market, 90% of those are closed. Right now, it's about 60%. Just because there's a lot more scrutiny once we get into the underwriting, that we want to make sure all things are there. So that kind of gives you the idea in this one. So the takeaway on that is a fix and flip. It's a heavy fix and flip, and heavy means this, that the purchase price and the renovation is almost the same amount. So you saw it's a purchase price is 187, and the renovation was 166. That's what they considered heavy. And with heavy, I need someone that has experience. I would not write this to a non-experienced flipper. So a non-experienced was someone who's 0, 1, or 2 flips in their last 3 or 4 years. They would be okay of doing a light and even moderate, as long as there's no extended square footage being put on the property. That shouldn't be a problem. But anything that's going to match or come close to the purchase price, the renovation, and that's what we consider heavy, and they are going to need to have experience. In most states, they need to have a GC license. But if they have a higher in GC, then they just have to show on their investment side that they've been the ownership side of fix and flips or several fix and flips, and that we're comfortable with their experience. Okay, when are we going to be able to use our funds for EV? Okay, so on EV charging stations, that's going to be another question that's going to be directed toward Alan when he has his business. Apologize that we kind of threw this at you guys in the last minute about this. It's going to be this one here. It's going to be mostly or all really real estate driven, and it's going to be that for private lending, it's going to be that 1 to 4 unit fix and flip, rental loans, new construction, maybe some multifamily, and they're vertical only. Now I might have some, if you have some projects that you might send my way, I might tell you, okay, email them to us, and then we can take a look at some of your things that might be interesting, but maybe not directly fit in our box. So in the future, I think what you want to do is you can bring a scenario where we didn't find an answer, and maybe learn from that and say, okay, how do we make this work in the future? So someone that didn't get a yes, and we're trying to figure out, okay, what's our best way to make this work in the future? Maybe someone that didn't take our loan. Why didn't they take it? Are we too high? Are we, something that might happen? So, we want to use this as a learning. I say real, like, real things are out there. Basically your day to day, what you're running into on a daily basis. We want to just kind of recap and think about situations during the week that you can learn from, teach to others, share with others, or help all of us as we're going forward. This is an exciting time, you guys. When the economy is really bad and gets to almost to the bottom, I mean, the upside on this can be just huge. So this is the time when you definitely want to be having people keep their number, because it's going to change. And when it's mostly a mindset. When people feel like, okay, they're not going to raise rates anymore, or there's a lot of opportunity out there in real estate, and people are sick of the equity market in stocks and some of the other things out there, they're gonna start looking to real estate. Now, some of your bigger, and this means that the smaller investor, it's an opportune time for them. Some of your bigger investors are going to say, hey, I'd rather put into get the 5% from the treasury deposit, because I'm going to put my 10, 20 million into a treasury deposit and make 5%, because banks need their deposits. So you can't blame them. So we're seeing a lot less larger projects, which is good for the smaller guys. So if I'm a builder and I don't have to worry about the Toll Brothers or some of these other big boys that are going to buy the Lennar, et cetera, take over and destroy the inventory and kind of, direct competitor of mine, I have the opportunity to now go build and do 1 or 2 spec houses, and build costs have gone down, so there's ample supply out there for products out there. So as a builder, it's a great time for you. You just have to understand that you can't get as high leverage, can't get 90%, but we can still give them 85% on a builder. So if a builder has a project, we'll give them 85% of cost, and then, which means this. Costs includes your construction and your lot or your land. So good builder, we can go up to 90% on a, maybe on a, I would say on an area that we might not feel as comfortable with, we might just go with 80%, or the margins aren't high enough, we might only go 80%. And what I mean by margins is, like, for example, we have these guys in rural Texas and they're building. and their margins aren't going to be as high because it's rural Texas. So their build cost is going to be, let's just say, 100. Well, it's 330. Okay, so let's just say 300,000 for build costs, and it's 100,000 for the lot. That's 400, but the retail is going to be only 550, so that's what it goes for. In this market, it might go down to 520 or 500. Is there enough margin in that? So as we look at those scenarios, we might not give them as high as leverage because we want to make sure that they can fit. We would like to have them put more skin in the game, as they call it. So we would maybe lower that to 80% leverage. So they would have to bring in 20% of that cost at closing, compared to something that was high leverage in a good area that we feel comfortable with. They might not only have to bring 10% of that cost in. So kind of goes hand in hand. Less leverage you have, the more we're going to want from you in the beginning, or the less margin you're making from your project. The more margin you're making for your project means that what you're building is going to have a really high market value and your cost is low, or something you might have got a real good deal on the land, etc., or the lots. But yeah, new construction for B to R, build to rent, that's common. They're easy. The reason it's common right now is because it's easier to get secondary markets to purchase those notes, or buyers that want rental properties. So that's kind of why that market is somewhat strong right now. What's not strong is going to be your spec homes. Your multifamily development means 100+ units because you're worried about absorption. Are you going to be, so a big builder is worried about absorption. If they're going to build 100 houses, do we have enough people buying them? So the big builders are worried about absorption. And then, of course, in some cities, we have a high inventory. Like here in Las Vegas, we had a lot of builders here within the last 2 years, and they just build and build and build. And now we have a high inventory of new houses. So, you have to look at that too, the inventory amount. San Antonio and Austin has had a high inventory. Dallas, some parts of Florida, but there's some parts of Florida that needs inventory too. So each area is a little bit different. So I wouldn't go into that too much. As you're looking for customers and clients, you don't want to be one of those where you're going to be studying the market so much, because what you're looking for is just opportunities. So you have to be very kind of like blank wall as you wake up each morning and saying, okay, there's not a right or a wrong. It's just whatever comes our way, we could turn it into a right. So basically you wake up and you say, all right, I might get someone that needs $150,000 loan on this, and we might get someone that needs $5 million on this. Each one, we're going to ask the same questions. Each one is going to take, the same type of due diligence underwriting. So don't look at having a specific target right now. I think the mostly what you want to do right now is tell everyone, your clients or any type of marketing that you do, that says, the main thing is we're lending now. We have funds available. So let me hear what you have, and we'll let you know what our rates would be. That's about it. Now, is there any other questions? I don't want to. Let's see here. I guess I can share one more. So we have a builder in Birmingham, Michigan. So it's a fairly nice suburb of Detroit. And okay, so he bought this property and started building. Yeah.
What's your email? I'm sorry to interrupt. What's your email address?
Okay. I don't know if we want to directly, Katrina, are you still on?
Yes, I'm still
Yeah,
here.
I'm still,
Katrina, can you tell what the email we should be sending our questions to me
Yeah,
at?
sure. So if you have any questions, send your email to support@seeklending.com. I'm just typing down the email address in the chat box.
We have
okay,
a deal with
okay, now,
Sequoia, so I have to, once the request comes through, that all of you guys, basically you're getting compensated for your clients, your client protection, etc. So we want to kind of go through this route for everyone.
okay, thank you.
But I'm available on a daily basis because Katrina always sends me questions and we have things that go. So I'm, as I'm running around, I will get to your questions as fast as possible
Okay, sir.
during the
Thank
week, even. Yeah, during the week. And I'll even tell you, like, remember, we're all in the same team because we all want to write notes. We all want to make our customers, make their project successful and get funding for them. So we're going to do everything we can to get those projects funded, at the same time not giving them a pipe dream, though, telling them what's reality. This is what we need. This is what it's going to take to make it work. Okay, is there anything else?
Right, if everybody doesn't have any more questions, I will just send you all a short survey. It's a poll which will pop up on your screen. So it takes like a minute.
Hello, Jason, can you hear me?
Sure.
Yeah, I just have one last question, if you could.
Mhm.
I have a customer asking me about a land investment and development. He says construction spec loan, stated income, no doc. What does that mean?
All right. So let's back it up into each phrase, okay? So land development, okay, that's what they would call horizontal. We're vertical, okay? Remember, we ground up and horizontal is going sideways, if you think about it this way. So that's the land development.
Okay.
Now, some lenders will do a combination of land development, horizontal and vertical. We typically want to stay within 3 weeks of getting that building permit. Okay, so my first question to them is, how soon are you from getting your building permit? And so if they are within 90 days, then yeah, we could tackle on that and start getting all the information we need. But for the most part, if they're 9 months away or 12 months away, then we'll tell them, come back to us when you're ready for the building permit. So you have it platted, you have it zoned, you have permitted by the city, then you're ready for your building permit. Okay, so what's the next part he put in there? What was the other parts of that?
They said it was a construction spec loan, stated income, no doc.
Okay, so we don't even have, well, yeah, it is stated. I guess we had an application that asked you how much you make a year. So it's the same. So it's a private lender, same thing as us. So basically means that you state your income. We never verify it, okay, because there's no income verification. And then no doc. We do have some docs, okay? There's nobody I know that just absolutely has no doc, okay? Because we do a LexisNexis report, we do a background check, so anyone that tells you there's no doc, it just means there's not a lot of documents you have to fill out, okay? It's not a bank, but we all have to know who we're lending money to, okay? So, but for the most part, we tell people it's a no doc. But in reality, there's some documentation we need. We need your social security number. We need your FICO. We need your experience in not only in the projects that you've done. So when they put the experience, we actually are, when we get to underwriting, we actually go through each one of those properties and make sure you're on the ownership docs. When we talk about we ask them for what their REO is, real estate owned. Yeah, we look at that. When we ask for their PFS, the PFS, we don't really go into line by line, but we do take a look at their PFS and say, does it match with the borrower profile that we need? For example, the guy that did a $6 million loan with us, right? He's getting $2 million at closing. Okay. Now, we are going to take a look at his PFS and his assets. Okay. We're not just going to, give someone $2 million, but let's just say someone that's doing a $200,000 loan and the property is worth 500. Well, do we really care what we're getting that property and we're only doing 40%. We're only committed to 40% of that value. I mean, any lender, hard money or private lender is going to say, we salivating. Of course we can do it. We'll figure a way to do it. So there's a difference there. Now, remember, guys, don't go to the other lenders or someone else say, hey, I remember Jason telling me this. Okay. I'm just telling you how I look at it. Okay. And everyone's going to be a little bit different. So, but I do have my other partners at Link, and then I also have my people at underwriting, and they're going to sit there, and even my CFO, they're going to kind of sometimes go back and forth with me. But I've been doing this enough and know enough that I can just tell you off the cuff if we can do something or if we cannot. And typically, I'll tell you what goes on behind the scenes is I'll go to our capital partner or even some of our other partners, and I'll say, we'd be stupid not to take this loan on. That's what happens behind the scenes. You guys don't see this.
Yeah.
So it is a committee, like 4 or 5 people that decide on the ones that are on the fence, on the loans that are on the fence. Go ahead.
Is there a limit? Is a numerical limit on that kind of loan, land investment and development?
No, I mean, that's one of those where you just have to get the figures. Okay, so I usually have 9 typical questions. Let me see if I can. Let me see if this works. I'm going to try something here and see if. Okay, so let me see if I can do this. Okay, those are my typical questions that you can get from anyone that you're sending out to. Okay, so if you're a broker, what is your fee? Okay, so you want to tell them what your fee is in the beginning, all right? Because don't try to get it at the end. As long as they know what your fee is from the beginning, then you don't have to come at the end. So then the name of the borrower, and the borrower has to be the borrower and the entity too. Okay, so if they have an entity, if they don't have an entity, it's okay. Just get the name of the borrower. The address of the property is big because why? We need to know where it is, and each property has an area which we zone as in different kind of settings for us. So we give a numerical value for each zone that it's in. So the address of the property is good, and the more rural it gets, the maybe we don't write, or we might have less leverage, etc. The better the area, then we might have higher leverage. Closing date, if purchasing, okay, that's key because we want to know if it's realistic. If they're closing in 2 weeks, probably not what we can do. Unless they got turned down by, or the last minute some lender backed out on them. Yeah, because they have all the paperwork already. So we might be able to do that one. That'll be the case where we could do it in 2 weeks. But for the most part, you'd want to know what the closing date is. If they're doing a refinance, we need to know the original purchase date because we need to know how long they've owned it, and the current debt payoff, things like that. Purchase price, this is for anything if you're buying a property or if you're renovating or if you're building. The purchase prices of the asset that you're purchasing. So it could be the lot or the land. It could be the house or the rundown house, etc. So that's purchase price. As is the value, what they feel that the market value is right now of that property. And this includes the land or the lot. Prior improvements, this is important if you're doing some kind of, if let's say if you bought the lot and you've already started working on it and you're going to build a house, we want to know how much you've already put into the improvements on that land. If you bought a house and you improved it, you already renovated it, now you need to do refinance or cash out. We want to know how much you put into it. Number of units, this kind of goes hand in hand. Most times it's going to be one. The renovation construction budget, we need to know what that is. And ARV is going to be after repair value. So that's after it's constructed or after it's repaired. We need that number. The ARV, those numbers are important because it gives us loan to cost and loan to value, and those metrics that we need as a lender. So you need to get that from every single one of your anyone that calls you up. You should be asking these simple questions, no matter what type of project. I mean, I give it to everyone. I don't care if you're doing a $10 million project or if you're doing a $200,000 project. I need these questions answered. And if you can get that to us at Sequoia, it'd be a lot faster for us to turn around and give you those the quote. And the faster you can get back to someone, usually gives you a leg up, because maybe they might not do that one with you right then, but they'll know that they're comfortable to going back to you and getting rates and getting a loan proposal. Borrower FICO. So we need what their estimated FICO score is. Rental properties owned and experience is very key because they'll tell me what kind of leverage and what kind of rates that we can give to them. And that's within the last 3 years. If you extend it to 4 years, I'm okay with that, but usually it's within the last 3 years. Borrower liquidity. This is key if someone's going to do some type of renovation or construction budget. We want to make sure that they have enough money to succeed. It's not because we need the money, right? It's because we want to make sure that they have enough to succeed in that project. So liquidity is important. Someone has no money, most likely is not going to get a loan from us. And that's true with most lenders, okay? You have to have some kind of liquidity. Now, liquidity, we go into some of these factors in depth some other time, but liquidity is not just the money that you have in your banks, but it could also include credit lines, credit card, revolving debt lines that you have availability toward. It could be, it just has to be liquid, means that you can get it within a couple of days. Okay, so long-term 401k or something like that, it's not really liquid. But if you have something you can pull from, some kind of investment or retirement account that you can actually pull from, that could count toward liquidity. So there's different ways, but the metric is this: liquidity. What we need is about 20% of the construction budget. That's what kind of liquidity we need beyond just a closing. For rental properties, this is key that we need this on every single rental property. Okay, we need a monthly rent. If it's not rented, we still need that monthly rent, like anticipated rent. Monthly HOA, so that goes into their DSCR qualifications. Annual taxes, annual insurance, and is the property currently leased? So this covers 90% of all projects you're going to run out there. Now, there might be some variances here or there that might come back with a follow-up question from myself or my team and saying, hey, can you find out this, and this? It might be 2 or 3, but for the most part, 90% of the time, I can give you a loan proposal and a yes or no if we can do that project based upon these answers. So I think many of you can just copy and paste that, and that way you know that you could send that to any email, and it's saves you a lot of time. And so if you get a phone call, like I do, I probably send this email out probably 30 times a day because I can't take in every single project and be able to remember every single one that comes my way. So I tell them, send me this. And then between myself and my team, we will put those figures in there. If we need some any more additional information we'll ask, but for the most part, we can get them a loan proposal, or at least an answer quickly. I hope that helps.
All right. All right. Thank you, everybody. I think we're passing our time. Now it's 1:20 in the Eastern time.
Oh, I
Yes.
apologize. Sometimes
No
I get
worries.
long-winded, so yeah. Thank you for keeping me on track.
Yeah, I
Katrina.
think that's because we got a lot of good questions, and Jason, yeah, Jason is doing a great job here. Thank you, everyone. So if you have any more questions, you can submit them here to this link, and Jason can answer your questions next week at the same time, Friday noon. And meanwhile, I will invite you all to take 1 minute to do a short survey. Just let us know how we did for today's training and what you want us to improve for the next training. Thank you all. The survey should pop out on your screen right now.
All right, thanks, everyone.
Thank you, everyone. Please complete the survey before you leave the room.